Hey, JB here from Squirrel for a little bit of a market update on house prices and interest rates. Obviously, the big news today that's not really news at all is that house prices are falling. Figure it out. It's actually been happening since about October, November last year. But the media is always a little bit late to the party. So look, what's happening? Well, the biggest driver here, I mean, look, there's lots of drivers, right? There's the removal of interest tax deductibility for property investors. There were the CCCFA changes that came through. There are LVR restrictions that are still in place. There's a number of factors that are making it more difficult for the housing market and certainly helping pull down house prices. But the major driver is interest rates. There's such a strong correlation between interest rates or mortgage rates and house prices. And look, to use an example, if you were buying a property last year for $1 million when interest rates were really low, you would have been able to, buy for $1 million, borrow $900,000. That same borrower now could only borrow about $800,000, and so their purchase price is down to $900,000, which basically says that from an affordability perspective, affordability's dropped about 10%. Or the maximum price that someone can pay has dropped by about 10%. So basically, it shouldn't be a surprise at all that we see house prices come back around that sort of vicinity. I think at the moment, most bank commentators are expecting house prices to have fallen about 10% from the peak last year. I think it could be a little bit more than that, just given the amount of headwinds. Maybe somewhere between 10 and 20 from peak. Now remember, peak prices went up over 20% last year. So what we're really saying is that house prices will probably settle down around the level they were at the start of last year. There's not going to be a housing crash, at least that's my view of it. And the reason for that is, look, although interest rates are going up and there's certainly a few pressures out there and there are some headwinds, as I was talking about before, the reality is we're at full employment. We're at full employment and we've got a reasonably high inflation rate running through the country at the moment. Big falls in house prices correlate with major recessions and correlate with high levels of unemployment. Now, even if we had a spike in unemployment, that spike in unemployment needs to be in the high skills sector, which is where the homeowners are. And from everything I see, the evidence I see, that's just not the case. What you also see is that, banks and even the Reserve Bank are very supportive of the economy and by definition, not by definition, but also the housing market when unemployment risk becomes an issue. And even banks are supportive. They're very slow to move on a mortgagee sale where someone loses their job. And we certainly saw that during COVID. So I'm not expecting to see a dramatic fall in prices. I think most of the price falls already occurred. So, suddenly it's news, but it's actually been occurring since October last year. And it's not necessarily a real price fall. I mean, all it's really saying is that around September, October, the few people that were buying in the market at the time were paying extraordinarily high prices, and that's kind of backtracked. So it's the reality is that 95% of the population, probably more than that, 99% of the population are still sitting on massive capital gains from when they purchased. So prices have pulled back a bit. Now there's a few things that sort of, yes, so some softness in the housing market. There's a couple of things that potentially can work the other way, right? And I think we're starting to feel this now. So we're definitely starting to see more buyers coming back into the market, feeling that houses, there may be some opportunities and that houses may be a little bit more affordable. We're starting to see that. Interest rates have largely done their dash, right? Now we're talking about the OCR peaking at 3%, or maybe a little bit over 3%, which sort of suggests housing rates of 5.5%, maybe getting to 6 temporarily is a bit of a stretch. But if you think about where housing rates are at the moment, we're seeing most housing rates now in the mid to high 4s and even the early 5s. So fixed mortgage rates have largely priced in this interest rate cycle now. They're not going to move a hell of a lot higher. And because of that, I think, you'll see people adjust to the interest rate environment that we're in, and be just a little less concerned about, whether rates will just keep going up. I think interest rates are going to do the job intended. I think you're going to see a pretty significant and rapid slowdown in things with these higher interest rates. Don't underestimate how much discretionary dollars that's going to take out of homeowners' back pockets. It really is significant. So I kind of expect to see that come back under control. The other thing that I think no one's really on top of is what's going to happen when we open the borders. Now, I've heard property investors kind of talking it up, saying that house prices will go up again. I simply don't believe that. But I think it could be a stabilizing factor for the market, as we have a lot of people coming into this country. And my understanding from talking to immigration businesses, that the numbers are staggering. Is that there's a lot of people that are going to be coming into the rental market here. It's a lot of people that potentially, certainly if they're getting residency visas, are going to want to buy. This is their new home. That's going to support house prices, and I think that's certainly another factor why we won't see a collapse. We'll see a reduction in house prices, fundamentally driven by affordability, which is higher interest rates, and then things will settle down. And I think most of that fall has come through already in Auckland, maybe not the rest of the country. And then look, parts of the market may fall further because it's fundamentally driven by supply and demand, and that's quite a nuanced thing, and it differs, suburb to suburb, town to town, city to city. So it's not one size fits all. But fundamentally, if you're looking for a big correction in house prices, that equals high unemployment, and just can't see that on the horizon at the moment. So look, that's a bit of an update on the housing market, and also I guess a bit of an update on mortgage rates. A couple of other things I think to think about in the near term. One is that you would have seen in the media that some of the triple CFA changes that went in before Christmas, that in a way have contributed to this really restricted access to credit in the current market. Some of that's getting unwound, and appropriately so. Recognizing that people buying property and business owners and older borrowers with lots of equity in their property aren't vulnerable borrowers. So that's a good thing, and we're expecting those changes to come through in June, and that will certainly make it a little bit easier to get into the housing market. The other thing I expect to see this year, as the housing market settles down, as we start to see a bit of a reduction in house prices, and a more balanced sort of supply and demand, I would expect to see the Reserve Bank ease back on its LVR restrictions, because they've done their job. And now that we have higher interest rates, I expect higher interest rates to do the heavy lifting in terms of getting control of this housing market. So, if I was to summarize that all up, I think we're going into an extended, quite a long period of reasonably stable nominal house prices. But bear in mind, we do have a high level of inflation. So in real terms, house prices are actually falling. In terms of absolute value of houses, I think the consensus is that house prices will come back about 10%. I think that's pretty accurate. And I think that 10% fall, you can pretty much look through that purely based on affordability and higher interest rates. I don't think it will go much further than that. There could be pockets of the market where you could see bigger falls, because what's happening in those parts of the market is quite different. And particularly parts of the market that are heavily exposed to tourism, hospitality, and retail, which are areas that have had a hard run. And retail in particular, it's not going to get any easier with this reduction in discretionary income and higher prices from inflation. I think there's some real challenges there for parts of our business community. So there you go. There's an update from me, and I'll talk to you guys again later. Cheers.